Tom for showing up here. Tom Wilson is from Northern California. He does a lot of stuff in Houston. He's got a lot of good stuff going on.
Dallas.
Dallas.
No, Texas.
Not in
Dallas,
Texas.
well, Texas and,
Okay,
and,
Texas.
and all over the country.
And all over. And I noticed that as soon as we put his information up there and let people know that he's going to be speaking at this meeting, we had a lot of hits out there, a lot of interest. So there's a lot of people very interested in what you're doing, Tom. So let's give Tom a hand for sure.
Thank you. Yeah, thanks for having me back again. I appreciate it. It's always a pleasure. Yeah. And we look forward to being back here in December.
December, that's going to be fun. Okay.
Hi, everybody. Nice to be back here. I'm always fascinated by crossroads. Many times there are points in people's lives that changed what path they took, but they don't realize it at the time. And how many can think of something like that? A special teacher or mentor or someone. And it's interesting how you don't always know that at the time. Well, today I'm going to ask, so how many people have invested in houses? Okay. How about multifamily apartments? Okay. How about commercial, non-multifam? Office building, retail, anything like that? Anybody? Good. All right. Got a ripe audience here. And why is that? Most of the time when I ask people, it's two things, right? They feel like you can't do it unless they have a lot of money. Or even if you have the money, you're putting an awful lot of money into one basket. And two, they don't have the knowledge or expertise. And the irony of it is that with multifam, that's the natural progression, right, to go in a multifam for those that have houses, but that turns out that's pretty complicated too. So I'm going to talk to you today about just maybe open up your horizons a little bit. Maybe it turns out to expand into other investment areas is not as difficult as you thought it was, especially if you get some help. So this was one of my first crossroads moments. I was born and raised in Virginia, got my AA degree at University of Delaware, came out to what was to become Silicon Valley in 1969 to go work for a company called Fairchild. That is where two-thirds of all semiconductor companies in the world can trace their roots to Fairchild. So for a young kid out of school, that was a really great door that I chose to walk through, and it did turn out just fine. So I landed here, and Fairchild found me a rental house, and I was surprised to find that the landlord lived next door, and he owned half the street. Think that was an aha moment for me? Yeah, you better believe it was. I didn't forget about that. So I bought a lot of properties in the 70s in what was to become Silicon Valley. It was pretty tough back then too. My first one was, had several people that were experienced, been around a while, and said that was a bad idea because prices had gone up so much in the 50s and 60s they couldn't imagine it could go up anymore. But I talked somehow my wife into going for it, and her hand literally was shaking as we signed the contract for $30,200 for a house that rented for $300. 1%. How many know the 1% rent ratio rule, right? There it was. So there was a time, even in high-end California cities, when that was possible. Well, since then, I worked for high tech for 30 years, did 2 startup companies that didn't hit a home run, and I noticed one day that my houses were earning more for me while I was sleeping than my stock options and day job was during the day. And I'd always loved real estate. So I decided to switch to that full time. And we studied the country for a good year and a half. Texas and Dallas came out on top, started selling properties in California. Now our team's a little bit bigger. Anybody go to the Bruce Norris's I Survived event this year? It is probably, I think it's a world-class event. It's a charity for cancer. My wife has been battling cancer for 10 years. Bruce Norris is, anybody know that name, Bruce Norris, the Norris Group? Bruce is a good friend of mine, and this was the 10th anniversary of I Survived. It's a charity for cancer, and it's a venue for a wonderful black tie event for real estate professionals and investors. And and we do that once a year. It's kind of like real estate professionals prom night. We get to have a good time and meet a lot of folks. Dr. Doug Duncan's become a good friend of mine. He's the chief economist at Fannie Mae, and I introduced him to Bruce many years ago. He's been on the panel ever since. And Doug Duncan this year will be going to a total of 83 speaking events, and he said that this is his favorite event to go to. So I really highly recommend you consider going there. It's great networking. So this is a good part of my team and my partners. So this is at the Nixon Library. It's held every year, and I'd like to say that we had this opportunity on Capitol Hill, but it was not. This was actually a replica of the Oval Office at the Nixon Library, but we had fun getting the picture. So Wilson Investment Properties these days is focused on providing commercial and multifamily syndications to investors like you for typically $50,000 a share. We've flipped about 650 houses in Dallas-Fort Worth to investors throughout the country, mostly here in Silicon Valley. We've bought and sold about 4,000 units in the last 17 years, so got kind of busy. But we have a wonderful team that handles that. We've stopped buying houses. Too hard to find at a margin that's good enough. We've flipped houses, we've had long-term holds. I have several dozen long-term holds myself. I still like houses, but they're liquid. They tend to appreciate well if you get the cycle right. However, in this market, there's just so much demand. If any of you are how many of you are trying to buy houses now somewhere here in Central Coast? Yeah, it's tough, isn't it? There's a lot of demand, very limited supply. Is it impossible? No. Linda just found one. But it's you need a lot of relationships, a lot of resources to feed a lot of deals to you so you can pick out a few. Even in Dallas and San Antonio, Austin, Houston, very difficult to find deals now with enough margins in it for it to work. So, you move from one area that's working to another. I like the example of steak houses were very popular throughout the country, not just Dallas and Texas, back in the 70s. And they, all of a sudden, America decided to get healthy, and they stopped going to steakhouses, but there was one called Sizzler, and they figured out how to deal with that. They put in a huge salad bar in the middle of it and offered some things other than steak, and they stayed in business. So you've got a model that worked yesterday doesn't necessarily, keep on working. You got to keep changing your model and changing what you're investing in so you can stay up with times. There are many, many different kinds of ways, of course, to invest in real estate. We've been involved in most of these flipping houses, land development, industrial, so forth. But you need to, it's good to focus, and it's also good to be willing to change to a different model if that model is not working as well as it did. So the natural progression generally is for people to start with houses, and then as they start to get successful with that, flipping, if you don't have much capital to start with, flipping is one of those ways, right? You can use other people's money, and you can do the sweat equity and make it happen. And once you get more experience, then you get a higher ability to do that. But it's, so how many of you are flippers? It's easy, just like on TV, right? No. It's a lot of work, isn't it? A lot of work. It's a business. And what we all like to do is to eventually build up passive income so we don't have to work. So that's a ways, that's usually a means to get to an end. So with, natural progression is to, yes, you can get a lot of houses long-term hold that work for me. It's hard to get any more, but I like, the ones that I have. I'm selling off some, but now I'm taking some profit off the table with that and moving into commercial syndications. And then you can have, then you can start to progress into other kinds of asset classes as well, and we'll get to that in a second. So whenever you attempt to do something new, you need to do some training. Last year when I climbed Mount Whitney, even though I walk every day for 3 miles and climb 1,000 feet outside my house in the Santa Cruz Mountains, I knew for me at nearing age 70 that I probably ought to get a little extra training. Right? So you always want to keep learning more, get more training. I just have always been someone who's been very curious and loves learning new things and doing new things. So I did that, and I was able to accomplish that goal of mine. I like learning from others. I hate reinventing the wheel. I read the little purple book about back in 2001, and got to meet Robert Kiyosaki in 2003, I think it was, and have spent several weeks with him over the years, more in recent years. And how many have read Rich Dad Poor Dad? How many would believe that this April was the 20th anniversary of Rich Dad Poor Dad? 32 million copies, all-time best-selling financial book in the world, translated in 51 languages, and it's in 109 countries. And it's so I get to sit by the guy on the day that he's celebrating the 20th anniversary, which is also his birthday. And is that is that cool and fun? Yeah, you better believe it is. But also, guess what? I learn every time, right? Every time I'm with him and all the crowd that he brings around, I get to learn more. He's been on a radio show 3 times. He just had his wife on. We'll get to that in a moment. But I love learning, and I love circling myself with people that I can learn from. Right? You've heard the old adage that you become the people that you most associate with. So every now and then, take a little inventory of the group of people you're spending a lot of time with. And if they're, we all like to give and help those that are in need and so forth. But as far as interfacing intellectually on a regular basis, think about whom you're associating with. Maybe some of those folks are not as positive as they could be. Maybe they're not as knowledgeable in an area you want to move to. It doesn't mean you can't have friends as just friends, but keep surrounding yourself by folks that'll help lift you up. And that's been, it's certainly been a big help for me. Here's some of the economists that I track. I've read and listened to many economists over the years. In this day and age, with real estate having a closer coupling to the economy, it's very important to track that so you can make good decisions about when to buy and when to sell in different areas. So these are some that I like. It's interesting that 2 of them here are self-made economists, and that would be Bruce Norris and Sean O'Toole. They're both self-made economists and are highly respected at what they do. Doug Duncan is professional, Robert Campbell is, and John Malden. And these are the ones that all of these folks on this chart right here called the crash in 2005 correctly, and they called the need before that correctly. Those are folks those are folks that are worth listening to. I've had the great honor and pleasure of being called back to Fannie Mae on 3 occasions. Each time I took Bruce Norris with me. They wanted to hear from the investor. They wanted to hear the investor view of what kinds of products we wanted and what kind of things could they do in the way of servicing the investor that would be good for society. A big ship like that, Fannie Mae is the largest lender in the world. And a big ship like that takes a long time to turn. And Doug Duncan championed our cause for a long time. And right now, it's very humbling to know and interesting to know that a small guy like me can actually have some influence on Capitol Hill. So of course we promoted that the investor should be treated as an asset to society, not someone who crippled us. It was the speculators that came in at the last minute that created some of the problem before as the collapse was happening. But all of us long-term investors would have lined up to take off a lot of these assets if they had been ones that had debt on it that could be serviced by the rent, right? We would have liked that. So we've been presenting what we thought was good to investors, and it looks like it's very high probability that they're going to lift the loan limit from 10 to 25 next year. And it's also looks like they may come out with a product that will allow us to get loan on a batch of properties and treat it just like they do multifam. As long as the rent can service the debt service with acceptable debt service coverage ratio, they'll have that product available. So I think that's something that is going to happen. Yes.
Would there be any change in Dodd-Frank? Is there a conversation about that?
Well, of course, Fannie Mae doesn't have any direct thing to do with that. Doug Duncan doesn't like it, but yes, I think the Trump administration is making progress on throttling back Dodd-Frank. And of course, when I go to meetings like this, I get to learn a lot and take back with me a lot of knowledge and relationships that help me as well. We had 60 people show up at this meeting. 20 of them were VPs, and the guy right there in the front, balding with his hand up, is the CEO of Fannie Mae, and he asked as many questions as anyone. Yes, sir.
Now, you mentioned 10 properties to 25. Has it ever been that good in the past? Has it always been 10 or less?
It was infinite in the past.
It
No
was
limit.
infinite. So there was a point where it was infinite.
Dropped down to 4, then back to 10,
Okay.
and so I think if we can get it up to 25, that'll be a big help for a lot of folks. So commercial. It's a little bit confusing. A lot of people think commercial is just office buildings and retail. The term commercial in the commercial world includes multifam, but in lay publishing and discussions, a lot of people think of that as just non-multifam, but it's both. Just to put it in perspective, give you a rough feel, there's about $500 billion a year of sales in both real estate, houses, of which there are about 125,000. So you run the numbers, that's about 4% of turnover in a year. And there's also about $500 billion in commercial real estate. This past year, there was close to $100 billion worth of foreign investment into our real estate here in the United States. So what are some of the different kinds? Land development. We're doing a land development right now in Rohnert Park, which is just south of Santa Rosa, where all the fires were up there. And it's a 194 unit single-family home development next to the Sonoma State College. So it's a path of progress spot that's already zoned. However, just to give you an idea of how difficult the regulations are in a state like California, we're buying the land, 48 acres, for $2.5 million. It's going to take $1.5 million more for all the work, surveys, and so forth to get it through the city and county, and so forth. And it'll take about 3 years to get this to happen. And in 3 years, we expect the value to be worth $14 million. So it's so difficult to get it through. That's $10 million worth of value that builders, of course, don't want to deal with. They want to build, right? Just to get, nothing will change with the dirt. It'll look like just like it does today. And they'll just to get it shovel ready. So it's not amazing. Same thing would take us about 9 months in Texas. So retail single tenant, retail multi-tenant, self-storage, industrial, and office, both single and multi. So there's some of the different kinds of, most common types of commercial products in addition to multifamily. So let's look at some of the key real estate terms. We can't go through all of them because of our time, but I want to go through a few key ones for you. Probably the most important one is cap rate, NOI, and property price. So who knows what cap rate is? So cap rate is the percent return you would get in the first year if you paid all cash for the property without debt. It's that simple. And why does that become a common metric? Well, debt can have a lot of variables, right? Interest rate, term, amortization rate, all of that. So by taking that out of the equation, it makes it a little bit easier to compare one to another. Give you a feel for cap rates in high-end cities in California now. Cap rates for a Class A apartment building are typically 5, so that's like 5% return. The same product in, say, Dallas or Houston will be about 6, 7, somewhere in that ballpark. Most of the commercial buildings that we're buying right now are cap rates of more like 8. So in times where it's more of a buyer's market, you can find some of these cap rates, say for a B or C apartment house in, say, secondary cities. You can find them up in the 10, 12 neighborhood. And of course, you have to do your own numbers, right? You can't rely on the seller and the listing agent. You have to run your own. So you know any two of these, and you know another one. So if you want to get $50,000 cash flow a year in a place that has a cap rate of 5, of a 10, you could spend $1 million and get it. If you go to a place that has a cap rate of 5, you'd have to spend $2 million in order to get that return, and so forth. So, you know, that's these are when you're in this business, those are things that are just going around your head all the time, and you're running these numbers to try to sort through and filter things. Triple net is very important in the commercial world. That means that the tenant is paying for typically taxes, insurance, and the maintenance. Absolute triple net, where you have a single tenant, they also cover the structure as well. But the most common ones in a retail or office building, the owner of the building covers the structure, and the tenant covers the rest of it. Depreciation in multifam and all residential, it's 27.5 years. No one's told me why the half, but my guess is that was some compromise on Capitol Hill. That sounds like a good guess. And commercial triple net buildings, non-residential, is 39 years. TI is 15 years. So the good part of that is, you know, we don't know what's going to happen in the new tax reform and so forth, whether or not some of these will get attacked or not. I'm guessing most of it will stay intact. We'll see how that pans out. But the nice part, of course, about depreciation is that you're able to offset income by the depreciation just as though you wrote a check for it, but you didn't. So that means that your income is mostly sheltered in the first few years, with if you have a leverage, a mild leverage, and that's a good thing. So how do I find metros I want to invest in? Of course, it's more important when you're dealing with residential and say retail, office, than it is, say, industrial. But we look for, first of all, the metros that have the highest cap rates. We then look to see if the probability is good that on paper virtual return is actually wind up in your pocket. Well, why wouldn't that happen? Things like collections and turnover rates, and how bad does the tenant tear up the property, deferred maintenance, all those I call spoilers that will take away from your, virtual on paper, it looks really good, to what the actual financial results are. And if you want the product to have good income and value in the future, you of course want some place that has employment growth and population growth. It's amazing how much cap rates and rent ratios vary around the country, a tremendous amount. So it really pays to shop around. You also want to look at migration patterns, both people and businesses. So this is one of the reasons why half of our business is in the state of Texas. This shows migrations from other states of corporate headquarters into Texas. So you can't read that in the back, but you can probably guess what state is on that left-hand column over there. In the last decade, 62 corporations have moved their headquarters from California to Texas. Texas has created 1/3 of all new jobs in the United States since the crash. So that's why, and as Dr. Doug Duncan says, all expansions end. So, you know, it won't go on forever, but I would guess they've got a little ways to go. Have to look at different real estate cycles, so that's why I follow those economists that I mentioned near the beginning to try to watch what's going on, but it's, you know, it's not the market. It is thousands of submarkets, different metros, different submarkets, different asset classes, different prices within that asset class. All of those have different cycles and at different phases. So, so that's a lot of work for, you know, for individuals like us. So you got to have on your team someone who has access to data through CoStar and other vehicles that can analyze right down to the neighborhoods and the type of asset class and the type of tenants that are in your retail center or office building, and figure out where are they in their business cycle. So you have a feeling for whether or not there's still some room left for growth, or if they're saturated and a point where it's going down. For example, right now, we're not a buyer of Class A properties in any primary or secondary city. All of those have pretty much expanded all they're going to expand, and they're starting to soften in some areas like San Francisco, even Dallas and Memphis and places like that. So that doesn't mean that maybe a Class C property that you can convert to a Class B that's in a Class B neighborhood, and even in one of those primary cities, might still be okay. Yes?
Secondary cities, you're referring to
Smaller.
like outside of a metro, or not necessarily?
No, a different metro that's smaller. Like
Okay.
Memphis would be a secondary city.
Okay.
Dallas, San Francisco, LA would be primary cities.
Okay.
Tertiary cities are smaller than that.
Okay.
Can be okay. Generally, you're going to have higher potential return and higher risk. So the good part is we have product choices, and you can, you know, go to different kinds of products in any market at any point in time and find where you can get a better return. So what's the big deal? What's the advantage of multifamily and commercial buildings in general? Basically, it's economy of scale. You can build a batch of apartments or condos for less per square foot than you can detached, separated houses, and so forth. Your operations are more economical. You can have a maintenance on site who can cover maintenance for a lot of units that would cost more if you have to send in somebody who's going to charge a per visit trip for it, etc. So here are some of the many different components that are involved in the multifam property. It's not just a bunch of houses all in one spot. You have problems when you have a lot of tenants all together. You want to have a property that's big enough that you can have full-time on-site staff, office manager, and maintenance that can help keep an eye on that, to control that. I tell people often, they ask me, what's my best cash return product I ever had? Not including development, because that's, you know, you hit a home run, or, you know, but it's high risk. And I say, actually a Class C plus multifam product. And they ask me, what's the worst performing product I ever had? Multifamily product. So it can vary quite a bit. So these are a lot of things that you can find out. By the way, if you go on TomWilsonProperties.com, you can get a bunch of PowerPoints like this that have a lot of graphs and data and a lot more detail than we have time for today, if you're interested in that. Because I'm a techie, a lot of my clients are techies, and they love all the data they come up with and graphs. So it's available there for you. So let's see, what's this one? Okay, so it's I like it because it's more predictable cash flow, typically higher quality tenants, longer term leases, renewal options, annual rent increases. It's got the triple net value, so it makes it easier to predict, right? If you're taking the burden on of insurance and taxes and so forth, you know, maybe there are a bunch of disasters that happen in a row in a short period of time. That could never happen, right? What's going to happen to insurance rates? Probably go up. If you have a commercial building like this with triple net, get pass that on to them. You don't have to try to predict what's going to happen. It takes a higher skill set to manage them, but if you have that skill set, it's easier to manage, in my opinion. The loan. Before the crash, loans were fairly easy. Everybody seemed to be able to get one. Well, they figured out that wasn't such a good idea either, so they stopped that. So here are the different kinds of loans. You know, single family in the 1 to 4 arena is all based upon the borrower's ability to service the debt. In commercial and multifam, 5 units and up, it's more based upon the product's ability to service the debt, although nowadays it's also a little stronger vetting of the borrower as well. And for example, they want the borrower to have a net worth usually at least as big as the loan itself, and so forth. And so in the multifamily arena, most of the loans are either by a regional bank or they're by Fannie Mae or Freddie Mac. And the commercial, and most of those, at least the ones with Fannie Mae and Freddie Mac, are non-recourse. That means if the product can't service the debt and they have to be foreclosed on, they can come after you personally for your assets to help pay the difference in the debt from what they can sell it for. In the commercial arena, the kind of equivalent to the big Fannie Mae or Freddie Mac, although it's not government backed, is CMBS, which is a commercial mortgage-backed security, so that's Wall Street money. You usually have the best interest rates and best amortization, but it's very difficult to get the loans. They're very difficult to deal with. It's very expensive. We've done several of those, and we can qualify for them, but they're tough. Regional banks are also an option. The CMBS loans are non-recourse. Again, regional banks are recourse loans, but it's really tough for new investors because unless you're already in the business, there's very difficult, almost impossible to get a loan unless it happens to be a product in your area, in the same region that the bank is, and you reside there and you have a relationship with the bank. So what are the solutions to that? You get a partner who can qualify, or you buy through a syndicator who can qualify. So let's look at some of the, look at this in any detail, but here's some of the steps that we go through on finding a product. Our team literally looks at, there are hundreds of products a day that come across the desk of our partners. They filter that down to about 5 or 10 per week that we then start to do, that we do the underwriting and vetting on, and 90% of that we wind up rejecting. So I tell our clients that in addition to taking advantage of our experience and integrity, there are other advantages, things they never see. It's the 90% of the things that we reject that they never get hold of. So once we get a product we like, then we put out an LOI, we try to negotiate that. If we're successful, then we get into a contract, we do more due diligence. We have our attorneys generate a private placement memorandum, which should be typically 100 to 150 pages. That contains all the disclosures and all the information that we can find about the product, why, how we vetted it, what we like about it, what the sales comps are, what the rent comps are, what the rent ratio is, what the returns will be. All of our products have a 8 to 10% preferred return, and typical internal rate of return average is about 15 once you include profit at the end. And then of course, everything you invest in should have an exit plan, whether it's a house that you buy or whether it's investing with a syndicator. It's important that they have a plan to exit. Can they change that if they think the market conditions aren't optimum? Yes, but at least it should be a target. You should be able to have a pretty good projected idea of when the intent is to exit from this product, so you know when you're getting your money back to make another decision on what you're going to do next. And a good syndicator should be reporting at least quarterly and giving the distributions out. I've talked to some folks who invested in TICs or syndications that a year or so has gone by, they've never heard from them. Well, that is not good. Even if there's a problem, right, you need to communicate to your investors as to what's going on and what you're doing about it. So everybody's heard the word crowdfunding. It's really just a new kind of buzzword for the word syndication. How long have syndications been around? I would guess back in Egypt thousands of years ago, there were two families that bought a goat together and shared the milk, right? That was a syndication. So it's nothing magical about it, except now it's highly regulated by the SEC because you're selling shares, private shares, to the general public, and so the SEC regulates that carefully. As I'm not a big fan of too much regulation, but I admit that I think there's some areas where it's valuable to have. So I'm going to see if we can run this video for you. Dan, how do we get the sound up on this, you know?
Okay. Probably would sleep.
And reset that if you will.
Okay.
And let's, I don't see a play pause light, but I think they did a wonderful job. In less than 60 seconds, they gave a good overview of what a syndication is. I'll try to click on that slide itself.
Wilson
There we
Investment
go.
Properties provides a variety of multifamily and commercial properties for investors called syndications. Syndications are a formal term for crowdfunding, where multiple investors come together to purchase a large, high-quality property, like a retail center or apartment complex. These investments are passive, so the managers handle day-to-day management decisions, while investors sit back and collect their share of rental income and profits at sale. During the typically 3 to 7 year holding period, income from tenants is distributed to investors as a preferred return. Upon sale, the profits of the investment are divided to investors. So basically, syndications are a hands-off way to buy higher price point properties faster, with less competition, less money, and higher return. www.tomwilsonproperties.com.
Did my team do a nice job of putting that together? I think very, very succinct. I like that. Okay, here's one more.
So you're considering a new syndication. What should you know? First, let's look at eligibility. All deals have a minimum investment amount to participate. Some require you to be accredited, which entails net worth and income requirements. Next, does it offer preferred returns or dividends? Preferred returns are accrued during the holding period of the deal and are paid before all other types of profit sharing. Dividends are paid toward these preferred returns from rents accrued from tenants of the property. Some development or value-add projects that are underperforming at purchase may delay paying dividends until occupancy has increased. These dividends are tax-deferred, paid on a K-1, which has the advantage of depreciation offsetting income. Most investors pay very little to no taxes on their dividend income. Profit sharing occurs at the end of the syndication when the property sells. After sale expenses and preferred returns are satisfied, all remaining net profits are split between the sponsor and the investors in a predetermined split. These profits are taxed as favorable long-term capital gains. Understanding the different pieces of a syndication allows an investor to intelligently invest in a rewarding way toward larger-scale real estate investments. www.tomwilsonproperties.com.
And if someone asks you, you say, I heard this guy talk and it's kind of interesting about syndications, but I don't, fully understand it, just send them to the website, and these two are on it. And I think that in a couple of minutes it does a nice job of explaining it. So syndication enables basically the smaller investor or someone who doesn't want to put all their eggs in one address to invest in multiple different investments that normally are only available to the very large private investor or to institutions. And you get to take advantage of the syndicator's ability to find deals, the ability to get loans, qualify for loans, be able to negotiate them, and manage it. And most syndicators like ourselves, our primary profits are at the end upon sale, so we're highly motivated to make sure this product performs very well. Of course, you want somebody with a track record and integrity, and who has this end of sale incentive, and who can manage it as well. So we're always looking for, you know, the best of these three worlds. You want always the highest cap rates, you want no performance risk, of course, and you want maximum appreciation, and of course they don't all come together, but you're looking for the sweet spot there in the middle. That's the best of those worlds that you can find. So as I said before, it's highly regulated by the SEC because they are securities, they're just not public. And the private placement memorandum is the vehicle in which we give you, that shows you all the details about that investment. And here are a few examples. Here's a $4.5 million retail center that we bought, and it gives an 8% preferred return and an internal rate of return of about 12%. So how many think, based upon headlines in recent years, that all brick and mortar is going to be scraped off the face of the earth in the next 3 years? Just when the headlines led us to think that, lo and behold, the largest e-commerce company in the world announces they're going to spend $13.7 billion for 460 brick and mortar stores. Pretty interesting, isn't it?
Is that Amazon?
Amazon, yep, Whole Foods. And, you know, we haven't seen that. So the answer is, yes, some retail's going to be in trouble. I just had a friend couple visit me who are the billionaires that took Kohl's stores from 30 to 800 stores. And he's in the retail business, obviously. And he said his prediction is that that 300 of the 900 malls in the country are going to disappear. But he said neighborhood service centers, anchors that have a good e-commerce component and synergy with them, that are probably going to do okay. So for example, you know, these neighborhood centers, can you get your hair cut online? Not yet. Can you drink a beer online? No. Get your dog seen? No. So, you know, service centers. So since retail's become such a four-letter word, we're now have relabeled it. We've been calling them neighborhood service centers. Here's a $10 million office building in Plano, Texas. Am I heard of Plano, Texas? Plano is a telecom headquarters in the world. It's and it's got this has a very high traffic count by it, and we project this at 9% preferred, 21% IR, because we found it below area occupancy, and our plan is to bring that up.
That entire footprint's $10 million?
I'm sorry?
That entire footprint's 10? Holy cow.
10.2 million.
You can't get it.
Yeah, it's 100 and something, 18 or 113,000 square feet.
Wow.
It's got national tenants in it, multi-year leases. Here's another retail center, again, 8% preferred return, 5.5 mil. Here's a power center we took down in Amarillo. It's $20 million. All the anchors in there have good synergistic e-commerce components. This is 14% IRR, 8% preferred, only built in 2008. It's on an interstate that has 84,000 cars a day going by. Looking at this, tenants in the mall down a mile away, the leasing agent says are begging to get into a facility like this because it's got more visibility, not stuck in the back part of the mall. Here's a multifam. Multifams are hard to find that can give good returns, but this is one in Fort Worth that we found, 235 door. Paid $17.6 million for it. It's a C plus and a B plus area. We're improving it to bring it up to that level, 8% pref. And here's an industrial complex. They don't look very pretty, but they're solid. This has got a 15-year lease on it. They make specialty aerospace parts for Boeing and Lockheed Martin. They have a 3.5-year backlog, 15-year lease. Been there for 35 years. I like that. So go to TomWilsonProperties.com. A lot of education information about, in general, not just commercial and syndications. That's on there too. We've been now in our 5th year of a radio show in KDOW, which is the leading business radio station in San Francisco Bay Area. We have all of them on podcasts on iTunes and YouTube. And we have guests on like Dr. Doug Duncan, Robert Kiyosaki, Robert Campbell, a lot of really high-level folks. We just had Kim Kiyosaki on there, and I heard of John Shaw, Peter Fortunato. Wonderful, wonderful guests, and I really enjoy getting to ask them my favorite questions. So remember, the only thing that matters is what you do next. And there are lots of options for you. So I hope I've opened your eyes maybe to some of those options today. So thanks for your attention. I appreciate it. Can we take a couple questions?
Thank you, Tom, very much. He's gonna get out,
Okay.
pretty soon, so we're gonna have to try and get him up.
Alrighty.
Now, if you do have any questions for Tom, we're gonna take a quick little break while we get Brett up here. Tom's gonna head outside. If you wanna jump out in the hallway and ask him some questions or something, you can do that. And then we'll have Brett up here. Brett's gotta leave fairly soon, after 4 o'clock. So we want to try and keep this thing rolling.
Okay, good.
Thank you.
You're very welcome.
Appreciate it.
My pleasure.
Okay.
So I'll up here, okay, to answer or outside?
Well, outside there in the
Okay.
hallway.